Hello there, I'm Shamla. In part 1 of lecture series 2, I discussed the definition of assets as set out in chapter 4 of the Conceptual Framework of Financial Reporting under Elements of Financial Statements. In this part of the lecture series, I will look at the other elements of financial statements, starting with liabilities. The conceptual framework defines a liability as a present obligation to transfer economic resource as a result of a past event. What is meant by obligation? An obligation is a duty of responsibility an entity has no practical ability to avoid. So, how do we distinguish between non-current and current liabilities? The settlement period of the obligation determines how liabilities should be classified. If settlement is within 1 year, it falls under current liabilities. Examples include payables and bank overdraft. If settlement takes place after 1 year, it falls under non-current liabilities. These may include bank loans, bonds, and debentures. Next, how does the framework define equity? The accounting equation of assets equal the sum of liabilities and equity can be rewritten to read as assets less liabilities equal equity. Therefore, this translates to mean equity is the residual interest in the net assets of an entity. Question: what causes an increase or decrease in equity? Looking at the equation assets less liabilities equal equity, this will be due to any changes in the net assets of an entity. If these changes in economic resources, assets, and claims, liabilities, is as a result of financial performance, this will result in income or expenses being recognized in the statement of profit or loss. An increase in assets or a decrease in liabilities as a result of financial performance will result in income increasing equity. Therefore, a decrease in assets or an increase in liabilities as a result of financial performance will result in expenses decreasing equity. What about changes in economic resources and claims not due to financial performance? Other changes. These include 1. Contribution from equity holders. This would result in either an increase in assets or a decrease in liabilities and thus result in an increase in equity. On the other hand, distribution to equity holders would result in the opposite, meaning a decrease in assets or an increase in liabilities, and this will result in a decrease in equity. Both contribution from equity holders and distribution to equity holders should be presented in the statement of changes in equity. Finally, with regards to exchanges of assets and liabilities, this would result in a change in economic resources, assets of the entity, and claims, liabilities of the entity. But as there is no change in net assets, there is no impact on equity. In the next part of lecture series 2, I will focus on some of the other chapters of the conceptual framework of financial reporting. I will look at chapter 1, Objective of Financial Reporting, chapter 2, Qualitative Characteristics of Useful Financial Information, and chapter 5, Recognition and De-recognition of Assets and Liabilities. Till then, thank you and have a nice day.